Madeline.
Good morning.
Hi.
Santé.
Bonjour, good morning.
Bonjour.
Bonjour et bienvenue au code de finance de marché. Préférez-vous les instructions en français? Do you prefer the instruction in English?
We would prefer it in English, please.
Each team has 20 minutes to present its case to the judges. I will show a board for the 10, 5, and last 2 minutes, and the last 30 seconds of the presentation. During the last 10 seconds of the speech, I will indicate by means of my two hands the number of remaining seconds. A team not having ended its presentation after 20 minutes will be stopped to move on to the period of questions. A period of questions of maximum duration of 5 minutes is assigned to the jury at the end of the presentation. I would like to remind each judge that it's mandatory to ask at least one question during this period. Please note that you cannot reveal the name or source of your university as it may be disqualified. I would like to ask the public to turn off the ringing of their cell phone. I will now invite the judge to introduce themselves. Je vais maintenant laisser les juges se présenter et ensuite vous pouvez débuter votre présentation.
Okay. My name is Jean-François Girard. I'm a portfolio manager at Desjardins Securities.
My name is Pierre Lacroix, Portfolio Manager at Desjardins Securities. Background, we manage assets. We are CFAs, and we overlook wealth management of our clients.
My name is Nicolas Vigirard. I'm working in the team since 2016, and I'm the trader in the team and stock analyst.
All right. Good morning, Monsieur Laporte. My name is Soule. These are my colleagues Madeline and Lucas, and we hope you look forward to what is essentially going to be the best 20 minutes of your day. So, let's get started with the company itself. So Deluxe Metal is an aluminum processing company with over a decade. It's spent over a decade in various stock exchanges. And what we've noticed is that you've had a period of a booming growth for the past 10 years, and recently your growth has been steadily declining. You yourself, Monsieur Laporte, you're a Deluxe Metal CEO. So congratulations on a wonderful career. You have 2 years until your retirement. I'm sure you're looking forward to that. And we are here to present to you basically a solid investing strategy to help you out. So, before we start, let's present ourselves. I'm Soule. I have a PhD in behavioral finance, and I've been with this group for over 10 years.
I'm Madeline. I have 15 years of work experience in the portfolio management business.
I'm Lucas, currently a Harvard student working on my PhD thesis where I see the correlation between the increase in cat videos on YouTube and the price of exotic call options.
So what's really interesting about our group is we've been together for a really long time and we know each other inside and out, and that's why we're the best team to bring forward a solution today. So let's go over the agenda. I'll be starting off with the investment policy statement where we'll be going over your investment constraints and your overall objectives. Then Madeline's going to be going over your investment strategy as a whole with a whole risk analysis and what we believe is the best portfolio for you. And finally, Lucas will go over the objectives and evaluation criteria part of the presentation where he's going to do an evaluation of your company as well as some hedging strategies. So let's get started with the IPS. So the overall goals that we've outlined for you are the diversification of your risk, the securing of your financial positioning for your retirement, and increased awareness on your investment strategy. But before we start with that, we'd like to highlight one of your biases. So we've noticed that you're highly invested in your company currently. It comprises 73% of your portfolio. And you say that you do this because you think it is the most profitable and most secure investment. This is, to me as a PhD in behavioral finance, a clear indication of representativeness, which is a common bias in investing, where it's investing in something that you're comfortable with without necessarily looking at the stock objectively. So this is something that we've taken into consideration while building your solution. So the breakdown of our investment policy statement, we'll be going over your constraints first, as well as your investment objectives after that. So to start off, for your time horizon and your liquidity requirements, we've noticed that you really have three separate constraints here. So the first 3 years of your retirement, you want to be taking out $1 million each year. After that, for the next 10 years, you'll be taking out $500,000 per year. And finally, after that 10-year period, you'll be taking out an annual $250,000 in the long term. So the strategy that we're going to be presenting really is a long-term strategy with varying liquidity. In terms of the timeline, we've defined it in 3 phases. So for the first phase, the first 3 years of your retirement. The second phase, between 65 and 75 years old, the next 10 years, right? And the last phase, after you're 75 years old, the long-term plan, right? So the portfolio and our strategy that we're presenting mixes liquid and illiquid assets and options to fit your specific needs for each phase. In terms of your risk tolerance, you have a high ability to take a risk, and that's outlined by the fact that you made a lot of money. So you do have a lot of money that you're willing to invest. However, you want to play it safe, and we've noticed that specifically with how you currently have your spread and your asset allocation. So what we're going to be doing is leveraging your willingness to take risk. We've outlined that you're a risk-averse mindset, and our strategy focuses on that as well. In terms of your return requirements, as we've outlined, you have several phases to your returns. So it's multiple phases with a low risk tolerance, and so we really want to highlight that our strategy recommends a mix of asset management as well as options in order to fit your objectives and hedge your risk. And finally, I want to re-outline the reasons for change are to diversify your overall risk. We want to satisfy your liquidity needs post-retirement, so the 3 phases that we've outlined. And finally, we want to correct your representativeness bias, which Madeline will be going over a bit more in detail as to how we're going to be doing that.
Yeah, so I'm just going to walk you through a couple of risks that we see the potential of affecting your business. So first of all, we see macroeconomic risks. However, currently the macroeconomic backdrop is quite favorable for your company. So right now there is a tax credit for the construction industry, as well as there's increased infrastructure spending, as well, in particular in the US. So we do see that being a positive for your business. In terms of your specific company, a few risks that are possible is having higher COGS. You currently do have higher costs than most of your main competitors, and we do see that as a risk for your bottom line and for your margins. And there's also a risk that tax credit that is currently happening in the marketplace is undone in a few years from now. In terms of our competition, we do see this industry as being increasingly crowded. There's lots of new competitors coming in, and that is actually driving down prices lower. And because you do have higher COGS, you do also have higher prices. So we do see risk in your company not having as much revenues going forward because customers are unwilling to pay at your price premium. So let's go over your current portfolio. As Sule mentioned, currently in your portfolio, it is 73% of it is DLM shares, and the rest is in fixed income. And as we mentioned, that does represent representative bias, and we do believe that this actually has extra risk for your portfolio. We are aware that the reason you're investing so much in this company is because you're comfortable with it, you understand it, you believe that it has a low risk. And although that is all very viable, we also believe that having a concentrated portfolio actually increases your risk. So the solution to that would be diversification. So diversification, what is that? Essentially that is not having all your eggs in one basket, right? So there's several ways that you're able to diversify your portfolio. The first of which is through asset allocation. So that's investing in different asset classes, fixed income, equities, alternative investments, everything like that. And then there's sector allocation. So within your equities, how are you diversifying? And then there's geographical allocation. So in what areas of the world are you investing in? Currently, your company does have revenues coming from many different countries, so that is a positive for you right now. However, we do think that your portfolio should be more diversified. So going forward, this is our proposed portfolio. We recommend cutting down the percentage of your portfolio in DLM shares to 20%. We believe that this is a good compromise because you do want to keep a significant portion in your shares. However, we believe that 73% is too large, and actually Lucas will be going over later some hedging strategies that we could use to reduce that risk of the 20% holding. In terms of fixed income, we do believe that you should add on to your position slightly because you are a risk-averse individual, and that provides steady, low, reliable returns. And then we also believe you should diversify into other equities. So there are many sectors currently that you're not investing in through just your DLM shares, and we'd be happy to go over what those other sectors are in the Q&A. And then lastly, we believe that you should go into alternative investments. So that could be through funds of private equity, real estate, infrastructure, and this will really provide a broader asset allocation to your portfolio, which overall will reduce your risk. And now, how are you going to do that? You do have such a large position in DLM right now, and if you were to sell those shares, you would realize significant capital gains, and those would be taxed very heavily. So in order for you to avoid these taxes, we are recommending an exchange fund. Now, what is an exchange fund? An exchange fund is simply when you swap a large amount of a single stock for a more diversified basket of stocks. Therefore, you're not selling, and therefore you are not being taxed right now. So that's how we recommend you going into these other equity sectors. So the overall takeaway from this is that your risk is absolutely reduced. However, we do see the potential for increased returns with your new portfolio. That's because we are going into other higher yielding equities, as well as fixed income, as well as alternative assets. However, because you are diversified, your portfolio does have less risk. And again, I'd be happy to go through the breakdowns in the Q&A period. And now I'll pass it off to Lucas to go over the objectives and evaluation criteria.
Thank you, Madeline. So first of all, you asked us to complete the balance sheet of the next 2 years as it was incomplete. So to do this, we did a bottom-up approach. So first of all, we knew the total shareholder equity in 2018 and 2019. And from there, we were able to figure out the return earning of 0. Now that we have the liability and shareholder equity, we also know that that is equal to the total assets. So in 2018, being 359 million. Now what's interesting here is that we had two more boxes that we had to complete, and we had to take in assumptions. So here we took the assumption that the property, plant, and equipment will remain the same as in 2017. So it will be constant the next 2 years at 209 million. Now this is interesting because we see that with this, the cash flow for the next 2 years is negative. And as we will see later in the ratios, this has an impact as not only your current assets, but also your total assets are diminished compared to the previous years from 519 million to only 359 million in 1 year. Next, we also took a look at your cash flow statement, which we're missing a few numbers. So here again, we took a bottom-up approach. So your cash flow from financing activity, we were given your cash flow from operating activity, we knew that it was 45 million and 66 million. And from there, we realized that your non-cash working capital is also 0, giving a total net change in liquidity of 8 million in 2018 and 31 million in 2019. And we see that overall, your decrease in cash flow from operating activities is having a varying change in your net liquidity. So next, let's take a look at a couple of ratios. So first of all, we want to take a look at the growth ratio, especially for the revenue growth. So we saw that in 2017, when the tax credit was up, that your revenues actually decreased by 21%. So this is a risk going forward for us, as we see that what will happen in the next presidential election? Will that tax credit still be there, in which case the revenue might decrease, or will the tax credit will be in place and so continue growing? Nonetheless, as the current government has installed that tax credit again, we do see that the revenue growth is growing in the next 2 years. We also took a look at your dividends payout. If you may go back, please. Thank you. And we see that your dividends payout, although we're extremely high in the current year at 35%, they are decreasing the next years. And with your current portfolio of 73% in those shares, this is a risk for you as your payouts will be less. So next, we look at the profitability ratio. And here again, we see that in 2017, they decreased as the tax credit came up. However, we also see that as the tax credit is coming up, they will be increasing again in the next couple of years. Now, what we like to take a look at is the return on asset, which was 3% in 2017. And as mentioned earlier, your assets are decreasing notably because of this decrease in cash. And even with this, which is why it seems that your return on asset are growing, but you have to remember that you have less assets, which is maybe a little bit skewed, to a higher return when actually your assets all over. So this is something to consider when we look at the ratios. So all in all, we do see that the company's profit are actually dependent on this tax credit. So next, we have the return on equity. So this is how much a company generates from shareholder investment. And this is simply calculated by the net income divided by the shareholder equity. So here again, we see that a decrease in 2017 to go back and increase again in the next couple of years. But here again, we've seen that the equity has been fluctuating a lot with the change in price per share. So next, we have the liquidity ratios, and this is really when we want to emphasize the risk of your company. So the working capital, is calculated by having the current assets minus the current liability. And what it shows, it's the ability to cover short-term debt. And as mentioned, your ratio, your assets, the upcoming years are decreasing. So your working capital is minus 73 million in the next year and minus 81 million, which gives you a current ratio of 0.42 and 0.4. What this means is that any ratio below 1 means that you have a high risk of not being able to pay down your debt in the coming years, which could have a high effect on you being an equity a shareholder. So, what about your debt ratio? Not only that, but as we saw, you have problems. You could have problems paying down your debt, but we also see that your debt is increasing the next coming years from 12% to 17%, which is an extra risk that we see with your company, which is why we recommend diversifying it away. And yes, exactly. So going forwards, you also asked us to have a business valuation. Now, in order to have a proper business valuation, the best tools for that are to do a DCF, the comparables of your competitors in the company to have a better idea, notably the Mexican company that is gaining market share, and also previous transactions. So we were not given, we would need a thorough analysis to have a proper valuation. Nonetheless, we went forwards and using PE multiples, we used PE multiples to value your company. So in 2016, we see that the PE was 7.3 and going up to 14.1 in 2017. Now, while the PE may be higher, we must remember that the earnings per share were a lot lower that year, which is why the PE is a lot higher. So how did we value a company? Well, first of all, we calculated 3 different courses. So the first one being pessimistic, neutral, and optimistic. So if I bring your attention to the bottom left table, we see that in 2018, a pessimistic would be a PE of 7.3, which was the same as the PE was before the tax credit, so 7.3. Next, we have a neutral one, which is simply the average between your PE in 2016 and 2017. And last but not least, an optimistic PE of 14.1. Now, I want to emphasize the fact that this PE 14.1 is extremely high because, again, of this low earnings per share that year. So going forwards, we did have the earnings per share in 2018 and 2019. So we simply calculated that, times that by the PE of those years. So we see that a pessimistic scenario, that the price per share will actually be decreasing to 4.38. And in 2019, after that, going back to your current price. A neutral scenario will also have a price decrease in the next year, only to go up in 2019. And last but not least, an optimistic that we see as rather unrealistic, where the price will go up to 8.46 and in 2019 of 14.7. So we know that in 2 years, you will go to retreat and you will need 1 million for your operating expenses. So how would you refinance this? Well, we recommend having a long put on the remaining shares that you have in your portfolio. So what is a put? So a put gives you basically the ability, but not the obligation, to resell your shares at a break-even price. So here your break-even price is $7, which means that at any point where the share price will go below $7, you will have the ability to exercise that price. So for you to break even, the price per share must be 5.49, at which point any price below that, you will make a profit. So in order to have $1 million in 2 years, we recommend having 142,000 contracts. It will cost you approximately $216. And with this, it will give you the ability to hedge your risk in the case of your price per share going down. So,
all right. So let's bring it all together. We started off by myself going over the investment policy statement, or some part of it, which was mostly the constraints, so in terms of your willingness to take risk, which is low, and as well as your time horizon and liquidity requirements. So we identified those 3 phases. The first one being in 3 years, in the first 3 years of your retirement, you'll be taking out $1 million per year. The second one being from the next 10 years after that, you'll be taking out $500,000, and finally, you'll be needing $250,000 after that for the rest of your life. Next, Madeline went over an investment strategy, so basically a reallocation of your portfolio. And what's important to highlight here is that because of the bias that we've outlined of the representativeness, and that you had your 73% in your company, we felt that it was necessary for you to diversify that risk. So we've outlined a complete breakdown in the appendices, and we look forward to you asking us questions about that. And finally, Lucas went over your company valuation and kind of give you an overview of how your company is doing as a whole. And then we went over a quick hedging strategy, so the long put. So all in all, we hope we brightened your day and kicked off a great day for you guys. And we look forward to your questions. Thank you very much.
Okay. I may have two questions. The first one, I would like to have an idea of the tax implication of your diversification strategy. I understand that you would like to use ETF swap, but it's not possible to do it on the NCR portfolio. And the second one, I would like to discuss with you, how did you arrive at the investment policy that you suggest with 40% in fixed income and 10% in alternative investment and 50% in equities. So I would like to hear why you suggest those kind of mix.
So I guess the main reason we did suggest that type of mix was because we did want to diversify, right? So I think that the reason for a slight increase in fixed income is because of that lower risk tolerance that the client does have. And so we did want to bring that a little bit higher. And then, of course, we have still the 20% in DLM stocks. And that is a significant portion for one person to have. However, we do see him in the future selling those shares as he goes forward and reducing that holding. And then in terms of equities, we thought that we would have 30% of the equity holding being in other asset classes. So we do have a breakdown of that, and that's really focusing on diversification of sectors. So consumer discretionary, consumer staples, healthcare, utilities, all the different sectors possible. And then in terms of alternative assets, we did think that that was something useful to add, particularly because it is such a long-term, illiquid type of investment, and we do see that having some add value to your portfolio. For example, real estate, that's a great inflation hedge, so we do think that it, again, diversifies your assets and just reduces your risk. And then in terms of the taxes, we do realize that selling the stock would have, a lot of tax implications, especially if you're going to then go and buy other equities. So we thought that an exchange fund would be a good way to reduce the overall amount of taxes that you do have. And so, yeah.
Okay. Do you have an estimate of the taxes, or?
I do not. No.
Okay.
In terms of the timing that you see that happening, because what we see in your balance sheet earnings statements, there's growth coming, and there's growth in ROEs. The guy is still sticking to his business. What is the kind of timing that you recommend for them to switch over your diversified portfolio, considering the whole thing?
Yeah, we did recommend switching it over currently, right now. And the reason for that is that we believe that while the business is doing well, we also think that there are perhaps more risks to the business than our client realizes. So we wanted to make that switch now. And of course, he does still have that holding within his company. So, if the company does well, he has quite a significant percentage of his portfolio in it, and he still benefits from that.
And just to add on to that, based on our evaluation with the PE, we see actually the price per share going down next year, which is why we want to diversify that away as soon as possible.
Okay, so you said that the client is supposed to keep 20% of DLM. Do you think that it's the best investment for him, considering that he is retiring soon?
Well, the reason we recommend him, we want him to keep 20% is, as he mentioned, he's very fond in this business. which is why, well, he has such a big portion in it, we wanted to decrease by 20%. But we do see the price going down, which is why we recommend having on top of that the put option, which is a hedging strategy in the scenario that the price will continue going down further.
One thing struck me as well.